Okay, I think we're just live on here. We're live. Good evening. My name is Saj Hussain and welcome to this live Q&A with me. Ask me anything you would like around property investing. We're on for about half an hour. Really, this is an opportunity to get your question answered. I've been investing in property for nearly 15 years now, so I'm happy to share my knowledge and experience with you for the next half hour or so. But just in case you are unable to get your question answered this evening, this is something that I do each and every Monday at 8:30 p.m. on my various social media platforms. That's Facebook, YouTube, LinkedIn, Instagram, and Twitter. So regardless of which platform you're watching on right now, if you've got a question you'd like me to answer, I'd encourage you to put it in the comment section as soon as possible. My lovely assistant, my 12-year-old daughter, is here helping me with the tech today, so she'll be firing up the questions on the screen. Just let me know you can hear me okay, whichever platform you're watching. Just say hi. I can see Kabir's message on Facebook. Hi, Kabir. Thank you for messaging. So if you just pop a message on the platform, if you're watching this live right now. Now, if you're watching this as a recording afterwards, then you'll still be able to benefit from all the questions, but clearly it's not going to be live. So these lives, as I said, run on a Monday at 8:30 p.m. for about half an hour. And really, it's an opportunity for you to get your property questions answered. So we'll get started in just a few minutes. Matt is on here as well. So hi, Matt, on LinkedIn, I think. I'm terrible without my glasses. So just a warning in advance, I am absolutely appalling at pronouncing names. So just a little a warning before that. Hi, Imran, I can see you're on here as well. So first of all, I just want to talk about something that's happened last week. I did do a video. I'm doing a weekly vlog as well that you may have seen on YouTube. If you haven't, you're missing out. Definitely get on my YouTube channel. I'm doing a weekly vlog where I'm looking at various different projects or strategies that we're doing or we're involved in. And last week, there were some changes announced with regards to the planning system. And there's some of the things that we've been looking at and deciphering and looking at where the opportunity is going forward. One thing that is for sure is there is definitely big opportunities on the horizon with regards to changes in planning. If you haven't already seen the vlog, have a look at that. Here's some the documents that we've been looking at. So these are the three key documents that I'm referring to. The first one is document number 755, which is really about building two-story extensions on existing buildings under permitted development. The second one, number 757, is the changes in the classes that they have, which is really the way things are categorized. They've been moved into different categories. So the creation of class E and class F, that's happening. If this is a little bit technical, don't worry about it. Essentially what it means is this is where the new opportunities are coming from. And number 756, this is the one regarding demolition, where we can demolish unused buildings and replace them with residential properties. So these are some of the changes that are happening right now in our marketplace, which are going to present some opportunities. And it's still a little bit early, I don't have all the answers around that right now. Speaking to some of the planning consultants that we work with as well, just to get a clearer understanding where some of these opportunities exist. Normally on a Monday evening, I also have a private group call with my inner circle. They're people that are on my mentoring program. And we were talking about this on there as well, about identifying what will be the low-hanging fruit, where the opportunities will be fast and most profitable, and going for those first. These changes are going to come into force on the 1st of September, so it's important that you're ready and prepared to take advantage of those. So I'm going to jump on in a moment and start answering your questions. I'm just having a glance over here. I've got some questions here. Last week, what happened, as we got towards the end, I just got a barrage of questions, but I've only allocated about half an hour for this particular session. So if you've got a question you want me to look at, it's important that you get it into the comment section as soon as you possibly can, because I'll just whiz through them in the order that they appear and try my best to get those answered for you. So don't leave it too late. If you've got a question for me this evening, pop it into the comment section and I'll go through those. So let's start off with the question. I think we've got some questions starting to come through. So let me just have a look what we've got. So this one is from Matt. Do you want to read this one, honey?
I am looking to take the step up from BTLs and SA to a commercial to resi project. What is your advice for starting?
So Matt's on LinkedIn. First of all, thank you for the question, Matt. So right now you're already doing buy-to-let, so you're doing service accommodation. Buy-to-let is normally portfolio building in my mind for the longer term. It means, yes, you make a little bit of money each month, but also you're building up assets for the long term as well. Service accommodation, generally speaking, pure cash flow, it's giving you great income each month. So next, it's a case of you looking at commercial properties and changing them into residential use. Certainly there's opportunities there right now, and with some of the changes that have been announced in planning, I think there'll be more opportunities. So you'll certainly be able to benefit from that. But before you start looking at alternative strategies, the one thing I would say, Matt, is just get clear about why you want to look at a different strategy. Sometimes it's just natural progression. We get to the point where we want to now do something a little bit different. But sometimes it can be we're getting a little bit bored with the strategy that we're doing right now. We just fancy change. And, you know, my view is, don't try and fix something that isn't broken. If you've got your buy-to-lets and service accommodation working really well for you, and that's delivering what you're looking for, then that's great. It doesn't necessarily mean you have to change strategies, but there may be many other reasons why you've already thought about why you want to do commercial to residential. Of course, one of the biggest hurdles is, and this is what I talked about in more detail in my last vlog, the biggest issue around these type of strategies is not the finding the buildings, is getting the permission, the consents to be able to change its existing use as a commercial building into residential. Now, once we have those consents and we're able to do that, often the value of a property goes up significantly. That's by just being able to get the planning permission to be able to do that. Now, there's also the strategy of being able to do that and then just pass that on to somebody else, not necessarily build it out all the way. And then, of course, thinking about, if you are going to build it out, are you going to keep it, or are you looking to sell at the end? So are you going to create a number of apartments that you're going to sell on, or are you looking to create the apartments that will just join your rental portfolio of properties you already keep, and maybe even running some of them as service accommodation, possibly as well? So it all comes down to the numbers. It's a little bit more involved than say your buy-to-let and renovations. And having the right team on board is important as well. In my vlog, not last week, the week before, I talked about a property, HMO project we're doing at the moment, where I've had to sack the builder, unfortunately, who hasn't quite been performing. But because we're very experienced and we have quite a few teams, it means we can move somebody else onto the job and finish it. So having the right people around you who've got the knowledge and got the expertise who can de-risk it for you, make sure you've got the numbers right, you looked at the funding in terms of how you can be able to purchase it, do the conversion, and also what the exit's going to be, whether you can remortgage it to keep or whether you'd be selling it on. So I think it's certainly an interesting strategy and one that's worth exploring. So thank you for that question, Matt. Hopefully that was useful. This question's from Shahid Udin on YouTube. Honey, do you want to read it?
Hi Saj, we would like to know how to release equity from a property to reinvest in an investment property.
So Shahid, this is a question really around mortgages, I think. I think that's what you're asking. Just as a caveat, I'm not a financial advisor. I'm just sharing my knowledge and experience with you. I'm not able to give financial advice in the way a financial advisor or mortgage advisor is able to give you. But ultimately, when you talk about refinancing, what you're doing is tapping into the equity that exists in a property. Now, let's say you've got a £100,000 property and you've got a mortgage on it that's, say, £50,000 right now. Most buy-to-let lenders will allow you to go to 75% of its value. So in this case, you can tap into another 25%. And ordinarily, that means taking out a new mortgage for 75,000. You take the 50 that is from the new 75,000 money to repay the mortgage that's already on there. So you now have a new lender, a single lender that's taken that debt from 50,000 to 75,000 as your new loan with them. So you now end up with £25,000 in your pocket. That's essentially what you've done. You're just, when you talk about refinancing or remortgaging or releasing equity, essentially that's what you're doing. Now, I'm assuming the property that you want to release equity from is an investment property. If, on the other hand, it's your home, then it's a little bit different because the way those mortgages are treated is it's different. So the first example I just gave you is really about an investment property. They look at the rental income you're going to generate. Are you going to be able to service the debt? i.e. the monthly mortgage payments? You have a buffer above that, 25 to 45% range over and above what the interest payments are each month. And that's how they look at it. However, if it's a home that you're looking at, then really another factor, a key factor is looked at, and that's your income, i.e. your affordability. They look at how much is it that you earn. They look at all your other expenses that you have right now, and how much can you afford to repay each month in terms of interest payments, and often it tends to be capital as well. So you're repaying some of the debt down and interest each month. Whereas often on buy-to-let, it tends to be the interest only you're paying each month and not actually reducing the debt. So residential is quite different. If you're releasing money from your residential property with a view to if you're releasing money from your residential property with a view to invest in property, it is going to take your income into account. And it may be that you're only with a spouse, and then both of you can look at your combined income as to what you might be able to borrow there. Then, of course, we're here because we all realize the benefit of getting involved in property and investing in property, not only for the long term, but also some short-term benefits as well, cash flow, flipping, or building equity for the long term, just to have an easier life in the future, whichever strategy it might be. So I'm certainly a big fan of investing in property, and of course you need some money to get started, and if you've got access to equity in your other investment properties or your residential property, that's an easier way to release some of that to get started. So Shahid, I hope that helped. Thank you for the question. Pierce is saying hi Pierce. So sorry, these questions are now starting to move really quickly. I'm trying to keep up. Just 1 second. I think I've got one here. So this question is from Taiba on LinkedIn. How do you want to read that question?
Hi Saj, wanted to know if a first investment is worth going for a flat or a house, as the return would be much quicker.
That's a great question, Taiba, and something I get asked quite a lot. To get started, should I be buying a house or a flat? Well, actually, the answer isn't that straightforward. And the reason for that is because it comes back to something I mentioned earlier, I think it was Matt I said too, where it depends why you want to do it. Why is it you're looking to get involved in property? Is it something you're looking to do for the long term? Is it going to be something that's going to supplement your pension? Or is it something you're looking to create an income now in the near future? Because the strategies you use are quite different to be able to do that. So for instance, if you're looking for a longer term benefit, i.e. being able to support you, say in your older age, some kind of pension that you're looking at, then what you're doing is investing not necessarily for immediate cash flow right now. You'll be probably selective by investing in areas that are going to give you good capital growth. So in nicer areas that generally rise quite quickly in terms of values. So as they go up, that asset becomes worth significantly more than it is right now. I'm sure you've heard property doubles in value over time, be it 10 years. Some people talk about 7 years to 15 years, every 20 years. But we don't know when the prices will next double in value. But what we do know is that the prices consistently, since records began, pretty much have been increasing over time. Yes, there have been little dips, various recessions, but the general trend is that prices go up and up and up. So be it 10 years, 15 years, 20 years, the prices might double on your property. So you end up with a property worth significantly more than you paid for it right now. So that's one form of investing. Your other form is you're trying to create income right now. So if you're purchasing a property that you're going to rent out and you're going to take an income from it, let's say it might be £500 rent you're collecting, you've got a mortgage of say £250 to pay, you've got management costs, maybe a little bit of maintenance of void to think about as well, and you might end up with a couple of £100 a month that you're left over. Now, of course, there's some taxation to think about, and how you're purchasing property is important because some of the rules around tax and interest has changed as well over the last few years. So generally speaking now, property investors who are building portfolios are buying in limited companies as opposed to their personal names, because it's now more tax efficient to do it that way. Now, if you're looking to decide, okay, that's fine, now do I do that as a house or as a flat, which is going to be better? Well, ultimately it just depends on where you are as well in the country. So for instance, if I'm in Birmingham, that's my portfolios pretty much in the West Midlands, and I invest in the West Midlands. If I was to go up to one of the northeast towns in England, the property is going to be significantly cheaper there than it will be, say, in Birmingham. And Birmingham will be, say, significantly cheaper than what it might be in London. So it also depends on, how much capital you're starting with, as well. So it isn't really a case of is a house going to be better or an apartment going to be better. It's thinking about what is it that you're trying to create, how much money you're able to put down. Personally speaking, I prefer houses as opposed to apartments, because the other thing with apartments to think about is often you've got service charges and ground rents that you're going to have to pay as well out your monthly rent that you collect to service the building, looking after the ground, the lift, and etc., things like that as well. So that's an additional cost. And of course, your lease decreases over time. So at some point in the future, that lease will probably need to be increased again. And of course, you now need to make another payment. So you're not in, so it's a number of things you're not in control of, which is why personally, as long as the budget permits, i.e. you can afford to do it, I prefer to purchase a house opposed to a flat, especially if I was in Birmingham. Now, let's say I'm in London and a house might be £700,000 or £800,000, and it just means that's way beyond what I can afford to do. Maybe you can get an apartment for £200,000, £250,000. That might be a starting point. So of course, those factors need to be considered as well. So I hope that helps, Taib. I hope that answers your question. So let's see. Have we got anything on Instagram? Instagram, where are you all? You're very quiet. Let me know if you've got any questions on Instagram. So let's see. So we've got a question here from Michael on LinkedIn. You want to read that, honey?
Hi, Saj. How has coronavirus affected the property market?
So Michael, a great question. Has coronavirus affected our business? Well, the way I think about my business is they split into kind of three categories. One is our primary property development business, where we're buying property, renovating either to sell or to keep. That's our kind of core business. Then I have a couple of letting agencies, specialist ones. One is for HMOs, and the other one is for short stay service accommodation type property. And then my third business is that training and mentoring business I run on, supporting other investors in their property journey. So with regards to just taking those in order of what we do. So with regards to our developments and the purchasing of property, so we're not really been buying anything in the last few months other than what was already in the pipeline. But in terms of the renovations, yes, we had a knock-on effect of things being slowed down quite considerably, and a couple of sites we stopped working on as well. And mostly it's been driven by the changes of not being able to get materials. It's been a big issue as well. Now, as we're coming out of that, most of that is now not had a lasting impact. Thankfully, most of those things we may be a little bit behind schedule, but we're getting back on track at getting those projects completed. So not too much of an issue. I did have a concern that the house prices were probably going to fall in the near future, and I was concerned somewhat about that. But I think some of the changes that the Chancellor's introduced recently, particularly around stamp duty and some of the planning things we talked about earlier on as well, some of these changes will probably slow down any potential price crash. We've yet to see what's going to happen with the market. So the development side of the business hasn't been too badly affected. Then coming on to our rental business, where we manage property, we collect rents. I had a concern there too that actually we might have quite a lot of tenants that are not going to be able to pay the rent, and that's going to cause quite a problem. But actually, amazingly, that hasn't been the case. We've had very few that have actually struggled to pay the rent, and we work with them, because I guess many people have been furloughed rather than losing their jobs completely. That means they're still actually getting some income, and for many people, their costs have decreased as well. So they're not necessarily been in a worse position financially, so they've still been able to pay their rent. Now, we've yet to see whether this is going to have a longer-term knock-on impact as people come off furlough schemes. Are they still going to have a job to go back to? If they start losing their jobs, unemployment starts rising, then this problem could still reoccur. But right now, it seems to be not such a big problem. It's kind of it's okay. And that third business, the mentoring business, the training business, the events that we run, clearly all the events have now stopped. We're not running any live events. I have a monthly property meeting that I run in Birmingham, where we have about 100 people at that every month. That's been ground to a halt since I think February was the last one. Was it January, February, the last one that we had? And when are those going to restart? Your guess is as good as mine. I'm thinking right now it may be October before we're able to run those kind of events again. And so the mentoring, a lot of the mentoring and support I do, rather than that being kind of live and face-to-face, much of it is now switched to an online format in supporting my mentees through that. So a bit of a long-winded answer, Michael, but in short, yes, there has been a bit of an impact, but it hasn't been too bad, thankfully. And I think we're going to be okay through this. I don't think it's going to have such an impact that's detrimental to our overall business. In fact, if anything, I think new opportunities will come from this particular situation, particularly around planning things that we were talking about. So how are we doing for time? Hopefully we'll get a few more questions in. So Michael, hopefully that's answered your question. Thank you so much for that question. Well, that's jumping fast. Just 1 second. So we've got a question here. For some reason, the name hasn't shown up. My apologies for that. Occasionally, it does that little bit of a glitch on the platform that we're using to broadcast and stream these live meetings. So, Hein, do you want to read that question?
If you're considering to buy a low in northeast/west for good rental
yields,
would you advise to buy in cash, 60 to 80k, or mortgage?
Okay, so first of all, very good question. Often people look to buy in the cheaper areas so they can get a better return on their money. So, for example, rather than buying, say £100,000 house, you go further up north in some of the smaller towns, some of the particularly more deprived areas as well. You'll get the houses cheaper and cheaper. So, same size house, but much lower priced than in, say, some of the more dearer areas or some of the bigger towns and cities. So the rents generally are a little bit less, but not hugely less. So what that means is that you're able to earn much more of a return on the money that you've invested in that property versus one that you would say bought in an area that's more expensive. So first of all, just a clarification in terms of the pros and cons of doing that. First of all, you might say, well, why actually would you not just go and buy the properties all in the cheaper areas? Why would you buy in the slightly better areas? So there's a question that was asked just a few minutes ago, and I said, you want to buy in a nicer area if you're looking for capital appreciation. So, for example, if you live in a fairly nice, so we're in Birmingham right now, we're in a nice part of Birmingham that we live in, and as the prices start to rise in a market, the nicer areas rise faster, so you get better capital growth. Then you've got the secondary areas that usually just surround the best areas, i.e. the next best areas. They tend to be the ones that also get pulled up as well. Then you get the properties that right at the bottom end in terms of price point, the lowest point properties, and they, often not in very pleasant areas, if you like. And they'll be the ones that rise last and probably by the least amount. So when you're buying in cheaper areas, often what happens is you don't necessarily get long-term capital growth in the same way you might have gone by investing in some other areas. But what you do get is a better return on your money each month as a yield, as long as, of course, those properties are managed well, that you have tenants in there that actually are going to pay you the rent each month and not cause a huge amount of damage or disruption whilst they're there. So the question really is around, do you buy for cash or do you buy with mortgages? Well, ultimately, this comes back down to what is your investing objective? What is it you're trying to do? A little bit similar to a couple of the questions that we've had today as well, around, are you looking to build capital for the longer term? The growth, is it just income for now? If it really is income, if you're looking at return on capital or return on capital employed, i.e. how much of your money are you putting in and what's the immediate return you're getting on that money that you've put in, then leverage is certainly going to help you do that. So if you mortgage those properties, so for example, it's let's say £70,000 property, you've got £50,000 of mortgage, then you'd only put in £20,000 of your hard-earned cash, but you're still getting the same rent. Yes, now you've got a mortgage to pay, but what's happening is your return on capital, i.e. the rental profit you're making on your £20,000 investment as a percentage is going to be much higher versus you not having a mortgage and purchasing that property in that way. Your percentage will effectively be lower. I hope that makes sense. So these are personal decisions depending on what ultimately you want to achieve. And of course, if you're looking to do a number of these, unless you've got a significant amount of cash, you can buy a number of properties. But actually, for most people, they'll run out of cash, so that's why they'll leverage. That's why they'll use mortgages. Now, of course, I know for personal reasons, some people may not necessarily want to use mortgages. But as I said, that's kind of going to be a personal choice. I hope that helps. Sorry, your name hasn't flashed up, so I'm not quite sure of the name there. Pravin saying hi. Hi there, Pravin. This is it Jordan, I think, question from Jordan on LinkedIn. Do you want to read that one, honey?
Good evening, hope you're well. I'm about to launch my deal sourcing businesses. How much do you reckon I should charge sources when I help them sell deals to investors? 20% question.
So I'm not quite sure what the 20%, Jordan, is that you're referring to, but essentially what you're asking is, if you're selling deals, what should you be charging as a fee? I think that's the question you're asking, so that's the one I'll answer. So the way to think about sourcing is a little bit like what an estate agent does. What an estate agent does, it approaches a homeowner that may be looking to sell a property, or an investor, a landlord, and say, hey, Mr. Owner, landlord, investor, or Miss Investor, landlord, owner, we'll sell this property for you on the open market. We'll advertise it on the various platforms, and we'll charge you a fee for that. And that fee might be £500, it might be 1%, it might be 2% plus VAT, whatever it might be, but that tends to be the range. So typically up to a couple of percent is not unusual to be paying for the seller to sell that property through an agent. So how is that relevant to what you're doing? Well, what you do as a sourcer is you act for the other person involved in that transaction, which is the buyer. So effectively, the crux of it is you're working as an agent for the buyer. Now, in some countries like America, it's much more common to see this. You have an agent on the sell side and you have an agent on the buy side. In this country here, we primarily only see agents for the sales. So as a sourcer, really, that's what you're doing. You're the broker, you're the agent working for the buyer of that particular property. So you have to think about what fee is appropriate to that. Personally, I think if you're doing that kind of a straightforward sourcing strategy, a couple of percent, 2-3 grand, depending on the value of the properties, is fairly reasonable. But ultimately, it comes back down to how much value you are bringing in what you're doing. So, for instance, if all you're doing is identifying a property that might be up for sale on Rightmove or Zoopla and say, hey, Mr. Buyer, I found this property. It's £100,000 or rent for this amount. It's in a nice area. We can put an offer in and try and get that property for you. Yes, you've done a little bit of work. You might understand the area. You're bringing some expertise in, but there's not really a huge amount of value that you're bringing there. So what you can charge for that is quite limited. Versus, for example, let's say you find a property that's direct to the vendor, that's not on the market. It's worth £100,000. You've agreed a discounted price. You say purchased price has been agreed at, say, 85,000. Now there's £15,000 of equity that's been built into it, and you've got the deal ready to go. Now what you're doing is bringing considerable more value to the table than you were in the earlier example. So you are, in my mind, justified to charge a higher fee for that. What would a higher fee be? Well, this is debatable, but it's really about what is it worth to somebody. Now, if you're bringing £15,000 of equity, charging £5,000, maybe a bit high, but depends what that is. If it's a £100,000 property, that's £5,000. But if it's a £500,000 property, that's significantly more. So it's looking at what is a fair and reasonable way to do it. The other way I'd like to think about this is I put myself in the shoes of the buyer. As a buyer, what would I be comfortable paying as a fee for that particular deal? Now, just to be clear, I've sourced for many years when I started out. That's kind of really what my strategy was. And I've purchased from sources, and I'll continue to purchase from sources as long as the deal is good. If it's a good deal, I'm more than happy to pay for that particular deal. Of course, it needs to be in the context of what it is. And I've paid some significant fees for properties that have been sourced for me because they have got, let's say they've brought a huge amount of value to that particular transaction. So I was more than happy to pay the fee because, of course, the way I'd benefit from that as well. So Jordan, I hope that's answered your question. I'm going to see if I can squeeze one more question in before we finish. I'll try and do another quick question. So let's do this one here. I think it's on YouTube. Was the next one that came up is from Jamie. If you fire away this question, honey, we'll do this as the last question. And if I've not been able to get around to your question, my apologies. I allocate about half an hour for this. We do this each Monday at 8:30. Just make sure you're here nice and early. Get your question put in nice and early so I can work my way through those in order they appear. So do you want to read this question, honey?
Hi Saj, I feel there will be a deep recession that will impact with this high unemployment. If this was the case, what would you say is the best HMO strategy going forward?
Yeah, so Jamie, reality is we don't really know right now, how much of a problem all this is going to pan out to be in the coming months and years. And I agree, it could potentially be quite a bad recession that we're going to face here. And if that does happen, and if you are doing HMOs as a strategy, then thinking about which is going to be the best type. Well, there's so many variations and moving parts to think about, but just as a very high level, the way to think about this is, who is your tenant? Who's ultimately paying you each month, and what risk are they at? Like, for example, let's say the furlough scheme had not been put into place right now. If your tenants were people that worked, say, in restaurants and hospitality, and they'd all lost their jobs, then yes, as a landlord, we'd definitely be in trouble if there wasn't the furlough scheme to support them. Now, if you're a student landlord and a lot of students have pretty much disappeared and gone home because the universities have stopped, and none of these things have happened before, so we couldn't work out how to deal with this and what we're going to do. But these things are possible, and as we're seeing, can happen and can massively impact our market. So I think, in short, we need to think about who it is that's going to pay and how are they going to be able to pay the rent each month. And I know some of the conversation I've been having the last couple of months, people have been talking about, well, I'd rather just have tenants that are going to be paid, or they have their rent paid by the government, whether it's social housing of some sort or supported living or whatever it might be. And yes, absolutely, there are another model. That's another model you can use in your HMO properties, which means you're not reliant on the individual to pay, but the government is paying on behalf of that individual. That's also a safety net. It's not necessarily something that we do on big scale. It's something we're kind of exploring and looking at partners to work with on that particular strategy. Personally, I feel more comfortable with a mixed strategy rather than having all my eggs in one basket. Because let's say we moved from, let's say the student landlords panic and they say, right, I'm going to social housing. But something could happen in social housing that means that market could change. What do you do then? We're never going to be able to predict the future, but we should be agile enough in our business model to be able to adapt as the market adapts and as the needs of that market changes as well. So, Jamie, I hope that's answered your question, or at least given you my perspective on it. Once again, thank you so much for your time. Thank you for spending the time with me on a Monday evening. I hope you're finding this useful. Just let me know in the comment section if you are finding this useful. Just a yes, or you'd like to see more of these, because I'm happy to spend the time and sharing my knowledge and experience with you. As long as you're benefiting, you just need to let me know that you are. Let me know in the comment section if that is the case. And if I've not been able to answer your question, my apologies. But best thing to do is on Monday's session, get here nice and early and get your question put into that comment section. So as I'm scrolling down, I can pick it out first and answer it. So once again, thank you so much. And I look forward to seeing you again Monday evening.